Welcome to The Explainer. You know, for any growing business, getting the right equipment is, well, it's a constant challenge. So today, we're going to map out the two main paths you can take to get the gear you need to thrive without breaking the bank.
I mean, it's a classic problem, isn't it? You absolutely need that new truck, or server, or manufacturing machine to grow, but man, that upfront cost can be a huge roadblock. For a lot of businesses, the answer is leasing. But here's the thing, not all leases are the same, not by a long shot.
And that's exactly where things get confusing. Just look at this person on Reddit trying to make sense of their truck lease. They're doing the math and they're like, wait a minute, these numbers don't add up. Am I missing something? And that's such a common feeling. These agreements can feel kind of like a riddle, and it's easy to wonder if you're making a smart move or a really costly mistake.
That's why we're here. In this explainer, we're going to untangle this whole mess. We're going to break down the two major types of equipment leases, giving you a clear roadmap to navigate your options, and most importantly, choose the best path for your business.
Okay, let's get into it. First up is path number one. Now, you should think of this one as the ownership route. This is the path you take when you know, without a doubt, that you want this piece of equipment to be a core part of your company for the long haul.
So, this option goes by a few names. Most often, you'll hear it called a $1 buyout lease. You might also hear capital lease or equipment finance agreement. But honestly, that first name really says it all. At the very end of the lease term, you pay a single, symbolic dollar, and boom, the equipment is officially 100% yours.
The key thing to understand here is that this acts a lot more like a loan than a rental. Right from day one, that equipment goes onto your company's balance sheet as an asset. And that's a big deal, because it means you can tap into some major tax benefits, like depreciation. You're making these fixed monthly payments, and the finance charges, they're just baked right in.
So, who is this for? Well, this path is really for the heavy hitters. We're talking about the big, long-lasting assets that are the true workhorses of your operation. You know, things like cranes, bulldozers, big industrial coolers, the kind of gear you're going to use for years and years, and that's going to hold its value pretty well.
Okay, now let's switch gears and look at the second path. And this one, well, it's a completely different animal. It's not about ownership at all. This path is all about flexibility and staying on the cutting edge, especially when technology is moving super fast.
This is what's known as a fair market value lease, or you'll just hear it called an FMV lease. At its core, it's an operating lease, which basically means it's a rental. The financing company owns the equipment, and you're just paying to use it for a set amount of time. And when that time's up, you have the option to buy it for whatever the going market price is. And the perks here are totally different. The number one reason people go for this, the monthly payments are usually a lot lower. Makes sense, right? You're not paying to own the whole thing, so it's easier on your cash flow. Plus, and this is a big one, you don't have to worry about what to do with the old equipment when you're done. The leasing company deals with that headache. And from a tax perspective, it's pretty simple. You just deduct those monthly payments as an operating expense.
This path is absolutely perfect for any kind of equipment that goes out of date fast. I mean, think about it. Computers, servers, IT gear, that stuff becomes ancient history in just a few years. An FMV lease is kind of like having obsolescence insurance. Instead of being stuck with a closet full of outdated tech, you can just upgrade to the newest model and keep your business moving forward.
Okay, so we've looked at the two main paths, the ownership path and the flexibility path. But the big question is, how do you decide which one is actually right for you? Let's put them head-to-head and see how they stack up.
And this really breaks it all down, doesn't it? It's a classic trade-off. The ownership lease, yeah, your monthly cost is higher, but you're building equity. You own the asset, and you get those great tax benefits. On the flip side, the flexibility lease has those tempting lower monthly payments and makes it super easy to stay up to date, but you never own anything. You're always just renting.
You know, if you really want to get into the nitty-gritty, this is the question that accountants obsess over. For them, it all comes down to one thing. Who really controls the asset? Who's getting the main benefits from it and calling the shots on how it's used? That single idea, the idea of control, is what on paper separates a finance lease from an operating lease.
All right, let's jump ahead in time. You've made your final payment, the lease term is up. So, what happens now? Well, your journey's not quite over. You've actually got some pretty big decisions to make at the end of the road.
Typically, you're going to have four main options on the table. 1, you can purchase the equipment outright. 2, you can trade it up for a newer model and start a whole new lease. 3, you could keep renting the same gear on a month-to-month basis. Or 4, you can just return it to the leasing company, shake hands, and walk away.
Now, if you do decide to buy it, that final price shouldn't be a surprise. It was actually set in stone based on the type of lease you picked way back at the beginning. It's either going to be that fair market value price, maybe a fixed 10% of the original cost, or, of course, that single dollar from the ownership lease.
So you see the pattern here, right? That very first decision you make has a ripple effect that goes all the way to the end of the term. The kind of lease you choose on day one totally shapes your options and your costs down the road. It's why thinking about the end of the lease is just as important as thinking about the beginning.
So, when it's all said and done, it really boils down to one simple question you have to ask yourself. When you're looking at that next piece of equipment, are you trying to build a long-term asset for your company, or are you just renting a tool to get a specific job done right now? Seriously, your answer to that one question, that'll point you down the exact right path for your business.